What's up, everybody? So you want to buy your first rental property. I wanted to go through today a step-by-step process on how I evaluate every investment property that I purchase. So let's use a real-life example. Let's say you were looking at a condo for $160,000. How do I know if that's a good deal? And should I buy it? So first off, on investment property, generally you've got to put 20% down. So using 20% down, that's the minimum. You can put more down, but generally I love to leverage with the bank's money. So the less money you put down, the higher return on your investment you can get. So we'll go over that briefly too, but the power of leverage and gaining appreciation on the bank's money is super critical in investing in real estate. So 20% down is going to put your down payment at roughly $32,000, which means you're going to finance $128,000. So that's your down payment, that's your purchase price, and that's your loan. So you're going to get financing for $128,000, that's your down payment. So let's figure out what an approximate payment would be with taxes and insurance and everything. Based on where current rates are today, you're going to be looking at about $725 a month for principal and interest. Taxes and insurance on this property are going to be about, so $160,000, about $125 a month. That's for taxes and insurance. And then generally with a condo, you're going to have an association fee as well. So let's estimate an association fee of $150. HOA. So total payment, that puts us at $7, $8, $9, that puts us at $1,000 a month. PITI and plus HOA, all in, $1,000 a month. So first thing we need to look at is what this condo would rent for. Right now, $160,000 condo, I would estimate to be at about $1,100 a month rent. So $1,100 a month in rent. How much does that leave us in cash flow? If we've got $1,100 rent, $1,000 mortgage payment with HOA, that leaves us about $100 a month in cash flow. Now, $100 a month may not sound like a lot of money, but we got to look at two things here. $32,000 is your down payment, even though the price was $160,000. You're borrowing $128,000 from the bank. $100 a month times 12. Let's do that as a yearly amount. That means you're going to make about $1,200 a year in cash flow. So the first thing I look at is my cash on cash return. Cash on cash return. What cash on cash return is how much cash I get over the course of the year based on my down payment, not the purchase price. So I'm putting $32,000 into the property and I'm making $1,200 a year on that $32,000. So as a percentage, that's about 4% cash on cash return. Now, 4% may not get you too excited. It's obviously more than you get in a savings account, but where the excitement really comes in is when you start looking at all the other variables. Keep in mind, not only are you getting this $1,200 a year in cash flow, but this payment right here, $725, principal and interest. A big chunk of this payment is interest, but you do have some principal being paid down on this as well. On a $128,000 loan, $725, you've got about $140 a month in principal pay down. So 140 of this is going towards the principal, paying this loan down every single month. So every single month you're going to see this loan amount drop. 140 a month times 12. So remember, we're going to take this as a yearly amount, not a monthly amount, to figure your yearly return on investment. So that turns into $1,680 a year. So this is more of what they call an internal rate of return. I call it an IRR. So this is a true picture of what your rate of return is on your money. You're getting this cash flow that goes into your bank account every month, but you're also getting $1,680 a year in principal pay down, which is kind of like a forced savings account. So that's also dropping your loan amount. So if we add the $1,680 to the $1,200, 1,680 plus 1,200. So your internal rate of return is actually 2,880 a year. Now let's look at our return on investment. So based on a $32,000 down payment, $2,880 a year, now it brings us to 9% return on investment. I'll take that all day long, which is why I love to buy rental properties. Now this does not take into account any sort of appreciation. So even if this condo stays at 160, doesn't go up a dime, I'll wait. I'll get my 9% return every single year until this moves up. So when you buy real estate, you don't want to look at it in terms of the next 12 months or 2 years. You want to look at it 10 years down the road. What is the value of this condo going to be next year? I don't know. What is the value of this condo going to be in 10 years? It's going to be higher than this, I can assure you. But let's say, let's just add one more variable to this, and which is why I love real estate and the power of being able to leverage is, A, you've got $100 a month cash flow. A lot of people right now think we're in a bubble. I don't believe we're in a bubble. I do think some sellers are unrealistic in their list prices right now, so you're seeing some price drops. But if this drops to 150 next year, do I care? No, because I'm not selling in a year, and I've got $100 a month cash flow. So I hold the property. You don't lose money until you sell. Where people got in trouble is they were buying properties under speculating that the property will forever go up in value. And when the market tanked in 2008, 2009, when we had the real estate crash, they had negative cash flow here, and so they dumped the properties. The negative cash flow was eating them. As long as you've got positive cash flow, you can ride the market. Now, if this goes down to 150, who cares? You're still going to get the same rate of return on your money. Remember, when the real estate market crashed last time, rents didn't crash. In fact, rents went stronger. On all of my rental properties through the crash, I was actually able to maintain or raise rents. So let's say, though, the market does go up, which we've got near historic lows on inventory, crazy amount of demand here in Las Vegas. But they say right now 40% of all Las Vegas searches for homes is coming from California buyers. So we've got a migration of California buyers here in Vegas. But let's be very conservative. Let's say this property goes up 5-6%. You know, we've seen 10 to 20% the last several years. That's not sustainable, we all know that. But let's just say it gets to a typical average, and let's say it goes up 6%. 6%, remember, you get the 6% not only on your down payment, but you also get the 6% on the entire purchase price, the 128 and the 32. This is the beauty of real estate. If you take 160 and we see a 6% increase, that puts us to a new sales price or new value, 6% increase. That gives us a new sales price or a new value of $170,000. Now, you paid $160, new value is $170, but you only put $32,000 down. Your value increased $10,000. You only saw 6% on the purchase price, but again, we got to look at our cash on cash return. You only invested $32,000. If the property goes up $10,000, let's add now $10,000 to our internal rate of return here of $28.80. So now we've got $10,000 plus the $28.80. Apologize, my handwriting's not the greatest. Puts us at $12,880 based on a very conservative appreciation level. $12,880 you made in 1 year on a $32,000 investment, not a $160,000. This is your down payment. Now let's look at our rate of return. $12,880 divided by $32,000. This is a 40% return. This is how you get wealthy in real estate. Using the rule of 72, that 40% return, that means you're going to double your money in less than 2 years. If I told you you could double your money in less than 2 years, would you put up $32,000? Absolutely. But the problem is people see this $100 a month and they go, it's not worth the headaches. It absolutely is worth the headaches. It's worth the phone calls on the leaky toilets. It's so worth it if you can get a 40% return on your money. So there's a lot more that we can cover here, but I wanted to give you kind of a real life example of what I look at in how I analyze investment properties. So go out there, go get your first rental property. If you have any questions, feel free to reach out. I'm an email or a phone call away, and thanks for listening. I appreciate it.